one of my good friends is huge into WallStreetBets. So what I start doing is I start dealing poker at night and taking the money and just YOLOing it. Those trades were Bed Bath & Beyond, which I sold at $53 a share. Palantir I sold at 45. GameStop I sold at like 450. I even sold BlackBerry at around like 20 or something like that. And at the time, the entire trade was, if it's on the front page of WallStreetBets, you buy it.
With the help of WallStreetBets, Brian bumped his modest poker winnings to more than $1 million in less than 18 months. But it didn't take long for the tides to turn.
I just want to get to 8 figures and be finished. You know, I don't want to deal with this anymore.
It's become a classic story. Someone takes advantage of federal government's printing money and
providing $2.2 trillion in relief,
and seemingly beats the system. But can this new generation of fast money keep their wealth? Today, we'll explore 3 stories from real people who may have cracked the code on how to get rich quick. And I'll walk them and you through my playbook for building wealth over a lifetime. Want a money makeover? Fill out the form in the description below for a chance to be featured on our show.
So in 2019, I go to college. One of my good friends, his dorm mate is huge into WallStreetBets. So what I start doing is I start dealing poker at night and taking the money and just YOLOing it. To give you an idea of what my first couple of trades look like, it would be something like read a comment and be like, Costco is a great company. And I'd be like, oh, let's buy the weekly calls. I once looked at the classic sort of meme picture of Tesla being worth more than the next 10 car companies combined. And that convinced me to short Tesla by buying weekly puts for months on end. And I would just make money in poker and then proceed to immediately lose it. I ended up losing a lot of money following the advice of people on WallStreetBets, but I was very, very headstrong. You know, I simply refused to give up.
That's good. Brian, persistence is a good trait.
So the first successful trades that I had were following WallStreetBets. I do consider myself sort of, you know, coming up as a meme trader. Those trades were Palantir.
Yep.
Those trades were Bed Bath & Beyond, which I sold at $53 a share.
Nice.
Palantir I sold at 45. GameStop I sold at like 450.
Nice.
I even sold BlackBerry at around like 20 or something like that. And at the time, the entire trade was, if it's on the front page of WallStreetBets, you buy it. And then you make money and then you sell. At least I sold.
Yep, exactly.
After that, the next sort of trade that I started doing was comment volume on WallStreetBets. So I would start. There were all these free scanners online that sorted WallStreetBets tickers by comment volume. So I would look at rising comment volume. I would wait for it to hit the front page, and then I would sell. So instead of waiting for it to get to the front page, I sort of moved the process back a little bit, and I would try to bet on which ones I thought might get to the front page.
So, Brian, you've been doing this for a couple of years now. What was your biggest loss?
My biggest loss was Avaya in December of 2022. Essentially, it was a penny stock. It was a telecommunication company that was trading at bankruptcy levels. I thought I was really, really smart because I read the 13G that one of the investors had filed, and they went through how it might gamma squeeze and all that, and that sort of triggered, the ape brain in my head. I heard gamma squeeze, and I was like, well, I've made a lot of money doing that, And I also was in a part of my life where I thought, you know what, I just want to get to 8 figures and be finished. I don't want to deal with this anymore. I'd sort of lost a little bit of the passion, I think. Partially for other reasons as well, other things going on inside of my life. I got dumped. So, for a myriad of reasons, I decided, you know what, this is going to be the trade. Yep. So I read the 13G, and I did a lot of what I thought was research, which was like, emailing investor relations, which I now know they will say anything to you. I DM'd a lot of big investors. I was like, who else is in this? And I got a lot of biased information. And I ended up, it was actually during an accounting class, or during an accounting final, when the AK dropped that essentially they were going to go bankrupt. It dropped that morning. So I read it that morning. I had an accounting exam I had to run to. I ran into the class. I was like, I got to do this. I finished in like 20 minutes. I ended up getting an 85, not bad. And I was like, I have to get out of here. I got out, I read the entire thing, and it was like a moment of clarity for me. I was like, wow, this company is actually going bankrupt. So I ended up taking a very, very large loss on that, close to 65, 70%. And I'd sized up really big for that trade because I was averaging down because I kept on taking in all this biased information. So that was, and I lost a decent amount of money. That's probably why I'm here now on the I'm a bad trader, episode, and not the I'm a good trader episode.
Well, Brian, there are a couple of things. First of all, and this has nothing to do with your intelligence or the hard work you put into doing research. That's not what this is at all. But more than likely, there's nothing that you can know about a stock or a company that 10,000 people don't already know. So something that's mispriced or some deal or some situation, is it possible you're spotting something that nobody else is? It's possible. It's just very unlikely. So again, this is something I think that you have to learn and work through. But a bigger issue is the psychology of why you ended up with that loss in the first place. And I think it's very instructive, even for me to remember this, even after doing this for 30 plus years, is there's no one trade that is going to make my career. There's no one trade that I'm going to bank on so I can retire and live on some island or on some 200-foot yacht or whatever your fantasy lifestyle is. That's not going to happen for me. Trading is a job. Regardless of your P&L, you have accumulated some very, very valuable market and trading experiences. Those lessons that you've been learning are going to carry you for the rest of your life. But one of the things that I have seen a lot of traders come and go is traders have a tendency, and it's a human tendency, to get imprinted by their first big win. Somebody once said traders are like baby ducks. Baby duck hatches, and the first thing it sees is its mother. If baby duck hatches and sees a battleship, it'll follow that battleship around the world, okay? So a new trader who has his or her first big win on the short side, let's say buying puts or buying calls or buying a cheap meme stock, thinks, oh, that's the way you make money in markets. What trading really is, or at least in my experience, is trading is evolutionary. So Brian, what's your portfolio right now? What do you have positions on?
Actually, I think that's one of the main reasons why I wanted to come on. I feel like I have too much cash allocation, but I'll give you what I have that's outside of cash. I have 20% in Snica Foods, which is a private label vegetable canned company. I really like the company, just their balance sheet. From a balance sheet perspective, they have they've been around since the 90s. They have a bunch of depreciated real estate, so I feel like there's a really safe bit of margin there. On top, they're trading at like half a book right now, so I don't think it goes much lower than that.
Okay.
Another thing that I have is TLT.
Yep.
I picked up TLT recently. I'm not gonna lie, a lot of that was influenced by the fact that a lot of traders I admire started going long bonds, and a lot of people covered. And then I own a decent amount of cash, and I have 5% in some sort of special situations. Those are the Spirit Airlines merger, which I'm following actively. Spirit Airlines and JetBlue, and then Omex, which is a phosphate mining company that's in a lawsuit with Mexico, and in early 2024 they're going to release whatever settlement that number ends up being. So those are two long call options for the sort of like special situation mergers, and then a lot of cash, which I think is the biggest problem. I could be doing a lot more with the cash that's sort of sitting there, especially because some of the money is tax deferred.
So Brian, is there a reason you chose to buy Seneca shares rather than look for something else that has options on it?
Yeah, so I was looking at a couple company-specific metrics. So it was dropped out of an S&P 600 index rather recently, so that provided some forced selling. There's not really a comp that has its price-to-book ratio, and I'm really, really relying on the real estate assets. They have some depreciated real estate that sort of gives me a comfortable liquidation value on the shares themselves. So in terms of finding comps in the market, I found it difficult to find comps that had those same attributes.
So I understand that, and that's as good a reason as any. My only thing that the only thing that I would change is the amount of capital you're actually allocating to that trade. I have no problem with you taking a shot on some stocks. None. Whether they come from Reddit or reports that you might read online or even your own analysis. If you want to buy some shares of a stock, go for it. And if there are no options on it, understand that that limits your flexibility. Okay? But when you limit your flexibility, you want to do it with a relatively small amount of your capital, like maybe less than 5%. Okay?
Yeah, that's really funny because I actually took down the exposure from 25%. I knew I would get yelled at for my exposure. So even before I came on here, I sold some. I was like, I know I'm gonna get drilled on for my size on this, so I might as well sell some. But looks like I'm getting
So,
my due.
and Brian, I'm
Anyways,
not going to criticize you at all on your analysis. You're probably right. Okay? It's just that again, you're making a 50-50 bet when you buy a stock. That's from my perspective. I could be wrong. Maybe there's an upward bias in the stock that you're trying to take advantage of. But from my perspective, it doesn't have options. It's completely unattractive to me. So just understand there are different ways of looking at it. To use up some of your capital, though, one of the things that you need to do is start broadening your horizons of what's tradable. So I mentioned some futures options, for example, that expressing a bullish bias in bonds, right? You can sell puts in ZB or ZN, for example. Look around for other stocks. So if you understand what volatility is, and you understand what volatility does to option prices, it increases option prices. What that means, Brian, is that you are being rewarded for taking risk when you short them. Okay? So that's why in my own trading, I like to look for stocks with options that have high implied volatilities. Trading low volatility options, I mean, I'll do it with a different strategy, but my preference is to sell options on stocks that have high implied volatilities because I'm being rewarded for taking risk. One of the things I think you should add into your daily analysis of the market, in addition to what you're already doing, don't stop what you're already doing, but add in a scan for implied volatilities. You can do that on there are watch lists out there that will show you the symbols with the highest implied whose options have the highest implied volatilities. They'll also show you which products are liquid and which are not liquid, which ones are easier to execute in, which ones are harder to execute in. And given that you're just starting, in other words, you're just trying to deploy capital, start with high implied volatility products that are very liquid. There is no reason for you to work with illiquid products, especially illiquid stocks that don't have options. I'm not saying don't dump your current shares necessarily, but the new trades you put on should be very focused on high IV, very liquid.
I would probably move the market a little too much if I dumped all my shares. Not to brag, it's that illiquid, I think.
You're a whale, Brian. You're a whale. Let's just face it. You're a whale. You're huge.
After one of my recent losses in 2022, I literally went through and categorized my wins and losses on every single ticker so that I could see where I was making and losing money, and I stopped trading SPY. It should have taken me a lot less time to stop trading zero data expiration SPY options, but that's what it took. It took me to look at my actual P&L on my SPY trades to be like, I have zero edge here. I should not be participating in this. When I started trading those zero data expiration options, it looked a lot like following news. So I would follow a couple of guys on Twitter, and I would just look and see when they would post something, and then I would be like, do I want to take this trade? And it was a very much sort of I'm bored trade. Like I was trading out of a necessity to trade, not because I thought I had edge, but mostly just because I thought I wanted to make money. And while these guys, I just kind of assumed, well, they're posting this information on Twitter, so I'm just going to follow them into that trade, and then without really even stops and losses, and a couple of times I would catch on to a really big move, and I would make like 10x or something like that. And so that's what kept me doing it until I really sort of stopped and looked at my actual P&L on those trades, just because like, even though I would. So, go ahead.
So, Brian, what strategies were you actually using? Were you selling puts? Were you buying call spreads or buying put spreads or broken wing butterflies? What were you doing in there?
So I would only open debit spreads or naked calls, naked long calls.
So buying out of money calls or buying in the money calls even.
Yeah, yeah. It was usually out of the money calls.
Okay.
Yeah.
So I trade a lot of zero DTE options. Um, and I generally make money on them. And I'm not bragging. This is not to brag. It's not to show off. That's not my point here, Brian. They're also they're also some of the most popular things to trade on the exchanges right now. And I'm not saying that you should continue to try zero DTEs. I'm not going to push you towards that. But a lot of what I hear you say is not so much a problem with the zero DTE options or how they work, or even maybe your directional bias, okay? But rather the strategies that you use to express that bias. So, for example, if you're bullish, what I hear you saying, Brian, is you would go out and buy some out of the money calls. And sometimes
Yeah.
they'd work and sometimes they wouldn't. Okay. And that's kind of the nature of out of the money calls. What I do instead is I'll sell a put. If I have the capital available, I'll sell a naked put, or a put's vertical. Okay. So it's out of the money. Am I going to make 10x on that trade? Nope. No. No, I won't. I will not make that much money on that trade. But here's what I'm doing, Brian. If I sell, let's say, a 5-point put spread in the NDX, and I take in a dollar, okay, for that put spread, for a zero DTE option, and I'm correct, and the market goes up, and like we've seen over the past couple of weeks, the NASDAQ has done nothing but go up, right? So what have I done? Have I made 10x? No. But if I keep that dollar of credit versus a $400 buying power reduction, I've made 25% on my capital in one day. So, Brian, you've got a great story. You've built up a lot of very good experiences in your trading so far, and I think you're going to have a very long career of trading ahead of you. But there are 4 things that I would suggest you do going forward that you can start tomorrow morning when the market opens. The first, define your risk before you do the trade. Keeping your size small is going to keep those huge swings in your P&L from happening. The second point is start to look for options with high implied volatilities in liquid products. Use those options instead of buying or shorting stock to make your directional biases. The third point is you're sitting on a lot of cash in your portfolio, and that might be okay for some people, but for a young guy like you, you need to get that working for you. If you start looking at some bigger index products, like the NDX, for example, that has higher implied volatility than the SPX, start looking at strangles or short strangles or short iron condors in the NDX, for instance. Why? Most of the time, the market doesn't really move big in one direction or another. Most of the time, it just churns back and forth. The way to take advantage of that is by selling strangles. If you want to use up a lot of capital, the NDX short strangles will use a lot of it.
How do you build these strangles? What kind of vol and what kind of theta? How long are these strangles built out for?
So I structure these short strangles or iron condors the same way I would pick any short option. I'm looking at expirations out to 40 to 60 days when the IV rank is about 25% or higher. That's my basic metric, and I will start from there. It doesn't mean I'm going to do the trade. It means I'm starting to look at it. The fourth takeaway that I would give you, Brian, is to start looking at pairs trades. Now, you do a lot of research into stocks and special situations. So I think you kind of like the idea of doing analysis and sort of applying quantitative methods to your own finances and trading. Pairs trades is another frontier of possibilities. Instead of saying, well, I think the NASDAQ is going to go down, you can say, well, I think the NASDAQ is going to go down relative to the Russell 2000. Okay, so I'll short the NASDAQ and I'll buy the Russell. And for example, that pair right now is the highest it's ever been. So you can actually see a chart of that pairs trade. And one way to express that trade is to, let's say, sell 100 shares of QQQ and buy 200 shares of IWM. Now, here I am talking about shares of stock, or the ETFs are not options. And the reason I'm talking about that in that way, Brian, is that to begin pairs trading, stock versus stock or future versus future can be a simpler way to try that out as opposed to option versus option. Once you've got some pairs trades under your belt to see how they work, then you can start doing option overlays. They're a lot of fun.
Do you dollar weight the pairs trades or do you beta weight the pairs trades?
So how do I decide how many shares of Qs do I sell versus how many shares of IWM do I buy? Why is it 100 versus 200? And Brian, there are a couple of different ways of doing it. The first is simply cash based, the notional value. In other words, how many shares of Q equals how many shares of IWM? And I try to get that dollar amount as neutral as possible. That's the simple way of doing it. I don't usually do beta weighting on my pairs trades, and beta, as you know, is a measure of how much a stock has moved in the past versus the S&P 500. So it's a measure of volatility. What I'd rather do, and this is something I think you'd have a lot of fun investigating, is using the implied volatilities of the products to see how much you should weight one versus the other. That is, if IWM has a higher volatility than the QQQ, maybe I don't need as many shares of IWM to hedge the QQQ. So there are different ways of approaching these pairs trades. Like I said, Brian, I think you could have a lot of fun investigating them.
Yeah, I kind of came in with the expectation that I was going to get roasted for all of my poor choices. But honestly, it was really, really fun. I learned a lot. You know, it was really fantastic coming into the office, meeting people, talking to you. There's a lot of takeaways. I think this will, improve my trading. I think it will give me a lot to sort of think about and sort of give me an idea for where to go next. That's the biggest thing, just to have sort of some vision, have some clarity and get, a place to go. So this was fantastic. Thank you so much for your time, for coming on.